Hey guys, welcome back to another episode of Market Champions. Today we've got Adam Wilk from Greystone Value. So thank you so much for being on the podcast and welcome to Market Champions.
Thank you very much for having me. It's great to be here. I'm a fan of the show and been impressed with the quality of guests that you've had in the
Thank you.
past. So I'm sure to be a letdown to your listeners.
No, it's going to be nowhere close. Yeah. So I wanted to start off with your background, how you got into finance, how you sort of entered, the finance world and your journey to Wall Street. So could you sort of describe your background for our audience?
Yeah, sure. So I have about as non-traditional of a finance background, or I guess no finance background, as you would imagine from an investment manager. I actually started my career in the sports world where I was working in basketball operations for the San Antonio Spurs and then the Houston Rockets. And my original intended career path was to try to become a GM of an NBA team, and I wanted to go down that route. And I
Wow.
got lucky by getting an opportunity to work in San Antonio for the Spurs for a number of years, and then moved around the NBA a little bit and lived in Texas before moving back to the Northeast. And I kind of always had an interest in investing. I was just doing some stock picking in my personal account, starting about a decade ago or so. And I definitely wasn't one of those kids who was buying their first stock at age 11 or anything like that. I don't really come from a family where investing or owning stocks was really much of an emphasis, or nor was it something that was introduced to me when I was younger. So I kind of stumbled upon investing just through my own interest. And while I was working in sports, like I mentioned, I was investing in my personal account. And I was always interested in studying different businesses and trying to figure out what moves the needle for an organization, which I got exposed to in a big way working in basketball. Kind of got a front row seat to the organizational development side of things and a really in-depth look at a business just from a different lens. And I always kind of had it in the back of my mind that if I were to ever leave sports or if basketball didn't work out for whatever reason, I might try to give finance a shot, but I didn't know too much about sort of where to take that. And I think through a combination of burnout and a few other things, I ended up leaving the basketball world a few years after I started in San Antonio. And I moved back home and kind of fell into a role in commercial banking. And during that time, I said to myself, I'll work this 9 to 5, and then I'll try to learn as much as I can about investing and finance and the industry itself and figure out
Right.
sort of what the available career paths are to me. And I turned to the internet, which is where anybody who doesn't know anything turns when they want to learn something, and stumbled upon an investing book called Rule 1 Investing, which was kind of a life-changing thing for me in terms of picking up that book. And the material is really it was easy to read and really well written, and kind of that thing in line with, the right book at the right time can make all the difference in the world. That was definitely the case for me. And after reading that book, it was written by a hedge fund manager who kind of follows the whole Buffett philosophy of investing, buy great companies at wonderful prices, that kind of thing. And the subject material was just really easy to understand and it was really interesting. And after reading that book, that led me to Buffett and his letters and all the books about him. And I kind of did what anybody who doesn't know anything about investing does, which is kind of go down a multi-year rabbit hole, trying to learn as much as I can about, the major players within the industry, read as many books as possible. I started studying different businesses and reading annual reports and learning about business models, and kind of taught myself accounting from the ground up as it relates to from an investing standpoint. And so I went down this really interesting rabbit hole for a few years, kind of this self-taught journey about trying to learn as much as I could and sharpen the sword as much as possible. And after doing that, the more I learned and the more I got involved in the industry, and I had a few successes in terms of individual companies, the more I realized I loved it and I was really interested in trying to make this a career for myself. And I figured out early on that some of the people that I admired most within the industry in terms of the best investors made their careers kind of working alone. Most of
Right.
their day was made up of reading and thinking and doing some writing and trying to put the pieces of the puzzle together, whether it's, trying to figure out a business model or learn more about an industry or the valuation piece of it. And that just really appealed to me from a freedom of schedule standpoint and in terms of how I wanted to kind of live my life, I guess.
Right.
And so I started managing friends and family money a few years ago, maybe like 5 or 6 years ago now. And I started at the same time, I started posting research on my blog and having a little more active presence on Twitter. And after a few years, I started getting a couple of requests from people I didn't know to manage their money, some outside requests to manage their capital. And I needed to put sort of a more formal structure in place to do so, obviously. So that kind of led to the founding of Greystone Capital. And yeah, here I am today. I guess 2020 was the first year of our operation. I really kind of launched everything in the back half of 2019 and
Right. Yeah.
started putting everything together in 2020. And I would call probably after this quarter is probably marks a year, one full year of operation. And just at a high level, Greystone Capital is a long only equity focused RIA. And I invest in a concentrated way, and I'm basically looking for severe mispricings within the market, and we can get into more detail about that. But
Right. Yeah.
I typically own 7 to 12 companies at a time for clients, and I do so on a separately managed account basis. And the top 5 positions make up a very large chunk of everybody's portfolio. And those businesses are found through deep research and really getting familiar with the companies and developing a high conviction level, and then sizing them up in an appropriate way to have maximum benefit on the portfolio, assuming I'm making the correct decisions. And yeah, and so today I'm just trying to kind of scale the firm. I'm very, very small right now. It's just me. And I'm basically trying to scale one client at a time. And that all centers around, accepting the right people and who think the way that I do and kind of align interests where, we're on the same page in terms of time horizon and the type of investing that I'm doing and what I'm trying to accomplish. So yeah, that kind of brings us to today where, like I said, I'm trying to kind of scale the firm one client at a time.
Right. And when did you leave basketball? Was it like before the crisis or before the
Which
2008?
crisis? 08, 09?
Oh wait, yeah.
Yeah, so I was working in basketball after that, so I wasn't investing on
Right.
behalf of anybody during that time period, unfortunately, because I think it was a little bit of a gold mine after the spring of '09.
Yeah, absolutely. At the end, you mentioned a little bit about your investment philosophy. So when you try to identify mispriced companies, if you take value investing as a whole, there's sort of two kinds of value investors. Just the kind of deep value investors, which are like the original Ben Graham, Warren Buffett kind of guys. They try to find net nets. They try to find um, companies selling below book value, selling below cash. And there's the other group, which is sort of they just try to find long-term compounders that can compound at say 12, 13% every single year. So which sort of category would you place yourself into? And also a more important question is how exactly did you find value investing to be your sweet spot? What attracted you towards value?
Yeah, that's a really good question. So I guess to back up a little before I get into the details, when I was trying to figure out a way to build a firm with my background and with just me kind of bootstrapping the thing at first, I basically took a look around the investing landscape and at the current investing environment. And I didn't really like what I saw. And you could point to kind of whether it's the move from active investing to passive investing and this focus on sort of low or no fee investing advice that has shrunk our industry a bit, or the rise of quantitative funds and index funds where you're not so much studying the fundamentals or breaking down the pieces of a situation, but you're purchasing or selling stocks on momentum, that kind of thing. Or whether it's securities being purchased regardless of price or value, which is kind of what's taking place right now in some pockets of the market. I kind of took a look at all that and didn't really like what I saw. And I thought that I could set out to build a firm that would sort of be a little bit differentiated and lead to opportunities for an active manager like myself, who kind of knows where to look and how to value a business. And so you can make money anyway in the market. I don't think anybody has the right to say, which way is the best or what somebody should be doing in terms of their philosophy. And really, when crafting your investment beliefs or your process, you really want to fit it to your personality and temperament and something that's going to work for you in terms of what you're able to handle from a concentration standpoint or volatility standpoint, or the types of businesses you like to look at. And I would say that everybody who sets out to buy something for less than it's worth is a value investor, meaning mostly nobody goes into the market thinking, I want to buy really expensive businesses that are overvalued and run by really crappy people. I would be surprised if that was anybody's investment approach. So the idea of buying something on sale is something that's applicable to a lot of different pockets of the market and a lot of different industries and a lot of different ways. Obviously, that's why we've seen some of the best investors of all time have very different styles and strategies. So for me, the idea behind forming Greystone was to try to form a firm that is differentiated from some of the larger asset managers and mutual funds out there. And it's kind of based on my investing beliefs, which center around 4 core things, basically, which is the market will occasionally offer up shares of high quality businesses at discount prices, that small companies tend to outperform, and where you can find wide distortions between price and value among those businesses. That volatility can be something that can be used to your advantage as opposed to a measure of risk, and that investing with a margin of safety involves purchasing shares of those businesses at discount prices. And so those are kind of like my 4 overarching investment beliefs. And my process has really centered around trying to take advantage of those beliefs, or basically put them into practice, where I'm trying to identify small and micro cap companies, which is the area in which I like to fish, that fit my investment criteria. And then I'll develop a watch list of those companies. And some of them I'll buy, some of them I'll just kind of monitor. And then I'll really only deploy capital when I've identified a severe mispricing, meaning there's a very low probability of losing money in the short term, but a very high probability of doing well in a specific business, because the valuation disparity just doesn't make any sense. So I invest in a really concentrated way, and I'm really looking for situations where I'm studying something and I'm putting the pieces together, and the whole time I'm just shaking my head going, this makes no sense. The market is missing something. What hasn't been identified or priced in is XYZ. And if it comes to fruition, the price is worth potential multiples of where the current business is trading, the current price is.
Right, yeah.
And so I'm basically trying to, I don't know how you would classify that, but basically my strategy, I have a specific investment criteria, but my strategy can basically be broken down to, I'm looking for mispricings where I want to find a good business that is going through has some hair on it and is going through some operational or structural issue that could be fixed pretty easily by a management team that's incentivized to do so. And within that kind of summary is basically two types of investments that I make. Core investments, which are kind of like better businesses that generate cash and have really good management teams and maybe able to compound money into multiple years into the future. And then there's special situations where I could look for sort of an event-driven thing, or there's something that's not quite, you wouldn't view these businesses maybe as compounders, as people like to say, but this could be like a business turnaround, a rights offering, a management change, a business undergoing some temporary issues, that kind of thing. And lately, what I've found is, and the type of investments that I like the most are the special situation type of companies that could potentially turn out to be really good businesses. And oftentimes they're mispriced in 2 ways. One, the market is over extrapolating the hair or the bad situation that's taken place. So you have a discount there. But then the other thing is that they don't recognize, the market isn't recognizing the potential to turn a business around or to start showing really positive fundamentals in line with some of the better businesses in the industry, which could then cause the business to really re-rate. So a really good situation for me would be to find a company whose stock, assuming it's not a great business that I can buy at a really good price, a great situation for me would be to find a company whose stock price has been hammered by something that's fixable, and there are steps being taken to fix it. And then once the fixes have been made, I guess, the company can then kind of grow into their competitive position, and there's an opportunity for revenue growth, earnings growth, or free cash flow growth, and margin expansion, which will then maybe lead to multiple expansion. And those situations, I know this is not very specific at all, but those situations usually provide really interesting opportunities. So, I learned about to answer your question, I guess, I learned about the value investing side of things very early on. All one has to do is read about Buffett to determine that what we should be doing is buying great companies at good prices. But you realize very quickly how difficult that is to implement, because I'm not the only, I'm a dummy trying to find good investments all the time, but I'm not the only person who's out there looking for things. And most of the time, the greatest businesses in the world are just not available at good prices. There are definitely exceptions to that, and there are certainly outliers. But the Facebook is not that expensive, I guess. But the Facebooks, the Amazons, the Googles of the world just don't trade at very cheap multiples, either for long or outside of sort of a general market-wide downturn. So as an individual investment manager and as a small shop, I think I have some advantages in place that allow me to kind of search in different areas and to make different kinds of investments, namely in small companies where larger funds either can't own because they manage too much money, or they just don't want to dedicate the time to do the work. That's certainly changing over the years. The market microcap space is becoming a little bit more efficient. I feel like at times I've had to kind of speed up my research a little bit here and there, because these opportunities some opportunities don't stay mispriced for long. But yeah, I think anybody who's trying to buy companies that are worth less than what they can conservatively estimate are worth down the road is considered a value investor. So my approach is along those lines. I don't really take the term as it has been defined in the past, which is, buy crap companies at really depressed valuations, maybe a multiple of their book value, or a fraction of their book value, and then wait until something good happens that will ultimately cause the stock to pop, and then, sell and get your 30, 40, 50% in a short period of time. I just don't know how to do that well. And I also want to sleep well at night. So I can't be buying companies that I think are, where you're holding your breath every time an earnings report is coming around, because you don't know how bad it's going to be. That's just not really my style or my strength. And I figured that out pretty early. So I try to kind of tailor my approach to what works for me.
Right, and could you also sort of describe your investment process? You mentioned that right now you're sort of focusing on turnarounds. So could you describe, number one, where you source ideas from? Do you screen for ideas? Do you go looking on, say, Seeking Alpha or Microcap Club, or one of those places? And then where do you start? And what goes on in the middle? And then how do you finally make a decision to purchase or to sell, or to take a position in a stock?
Yeah, that's a great question. So just at a high level, my process is pretty simple, to be honest. I think I say no to a lot of things, and that really makes up a big portion of what I do day to day. And or I guess I can back up. So the majority of my day or weeks or months are made up of basically two things. One, managing the current portfolio, because I invest in a concentrated way. So I really have to be on top of everything that's happening in terms of news flow and company developments for the most part, and the competitive environment. And so I spend a lot of time kind of like, I would describe it as like buy and verify. So I spend a lot of time kind of like verifying the investment theses for the businesses that I own and the competitive positioning, which is hard to do, but it takes up a good chunk of my time. And then the other portion would be trying to find new investment ideas and doing research, reading write-ups, spending time on forums, as you mentioned. But and I think it's important, having an investment process that you stick to through all types of market environments and good times and bad is really important to do when you invest the way that I do, or that other small microcap managers do. Just because it's important to be consistent, and it's important to kind of track and measure your decisions, because there are a lot of false positives in investing. And yeah, so
What do you mean by false positives?
So like so you can make a bad decision by investing in a bad business or partnering with a bad management team, and somehow maybe you can still make money or do well in a name.
Right. Yeah.
That doesn't tell you much about the actual decision that was made. It just tells you based on the result that you did well.
Yeah,
and then
right,
on the other end of the spectrum, you can make a really good decision based on the information that you have at the time, and you could invest in a quality business with a good management team. And maybe you made a mistake on assessing the competitive positioning, or a black swan event happened, or something came out of the blue that caused you to lose money, or you had to sell the position at a loss or something. If you are tracking your decisions instead of just kind of the outcomes, which people like to call resulting, I guess, you would get a much better view of what went right or went wrong versus if you made money or lost money. So that's what I mean by false positives. Is in investing, it's actually full. This business is full of those false positives, because, like I said, you can make a bad decision and make money, or you can make a good decision and lose money. So it's really important to kind of track the actual decision-making process over time, which is also very hard to do, but it just helps sort of filter out any noise over like a long period of time that you can refer back to.
Right. And one thing that I found interesting in what you just said was the concept of time horizon, and how typically value managers tend to have long-term time horizons, 5 to 10 years out. And you've got people like Monish Pabrai and Warren Buffett who've said that the best time horizon is holding a business forever. Now, what I've now you, at least at the moment, are sort of focusing on these turnaround plays. So do you sort of just wait for the company to turn around, finish fixing their balance sheet, and you see a spike in the stock price, it goes up, say 100, 150, 200%, then you sell? Or do you plan to hold those businesses for the long haul? And how do
Yeah,
you
that's
look
a
at
great.
that?
Yeah, that's a great question. I think it varies, and just to kind of reiterate. So I don't look for turnarounds. In general, those investments can be very hard to understand and make money on, and it's a lot of execution risk can be present with those at times.
Right.
But basically, what I'm saying is the best kind of investments for me usually involve a pretty good business, or a good business that's just going through some temporary issues. It may not be like a full turnaround where a company has to cut costs and refinance their debt and enter a new market, or start selling into a new vertical, and then the management team has to do X, Y, and Z to make sure they're competing on the level of the other of their peers, and that kind of thing, which can be just a tough way to make money. I'm basically looking for situations that are to use a basketball term, like layups, where you can see a clear path to some fixable issues, and if that were to happen, that alone should cause investors to kind of perk up and pay attention, and should help the share price. But then there's also something about the business itself, like it's a good business, where if they can fix these kind of solvable issues, that they're able to just continue to execute status quo, which will in turn, cause the fundamentals to look better. And that's all mostly driven by, a good management team. But so just to be fair, if I would love to buy Google at 7 times free cash flow or something, because that would be a great investment that I would hopefully hold forever. But this past year, I actually ended up finding multiple businesses in the kind of lens of what I just described, where they're good businesses, they generate cash, they're growing their top line, but they were just going through some temporary issues, whether it's a management change, or they levered up a little bit too much, or there's an activist battle, or the company's underspending on growth, or something along those lines, where somebody can come along and kind of fix that. So those are really the situations I look for. In terms of holding period, it definitely varies with every investment. And I will say, even for like the Monish Pabrais and Buffetts of the world, it's very easy for them to talk about, our favorite holding period is forever, et cetera, but rarely do they actually act that way, because
Sure.
things change over time, whether it's, industry change or market change, or you need to raise cash or you find a better opportunity. There's always kind of that, those calculations taking place in your head about what to do with the portfolio, whether you're managing a personal account or you're managing a few $1 billion. So it's very hard to have these like hard and fast rules in investing that you just stick to no matter what,
Right.
outside of like your process or your strategy, because things change very rapidly all the time. And I can, as a few examples, I can remember buying a business that I wanted to go long for a really long time, and then I would sell it, a few weeks later when I found some new information that made me less comfortable about what I owned. Or
Right.
I could buy a business that I thought had, 200% price appreciation potential, and it jacks up 75% in a couple weeks, and then I have to reassess, what happened, or figure out if I want to keep holding it or trim the position, or if I was given like a free gift like that. Or there could be a business where there's a really good business on sale that, like I just mentioned, had some easily solvable issue that it was dealing with, and maybe I'm able to buy shares at a depressed price, and
Right.
that I want to hold on for as long as I can, as long as the business continues to execute and their competitive positioning remains intact. Maybe I'll hold that for 5-10 years, something like that. So it definitely varies with investment to investment, and it just depends on the situation, I would say.
And as you mentioned, George Soros has that strategy of sort of invest first, investigate later. So he takes sort of a small position at the start, and then he'd go ahead and investigate the company just as you would. And if there's something that if there's a new piece of information that sort of invalidates your original thesis, he could just either get out for a very small loss or you'd make a small profit. And then there are times like you mentioned, it would just jack up, or just rip 75, 100%. And then you'd have to reassess that. And one of the interesting things that I saw, that I heard you mention, was you said that if you were able to get Google at 7 times cash flow, at 7 times free cash flow, you would own that, possibly forever. So as now, as sort of following the strategy that you do you focus on sort of price multiples? Do you focus on sort of discounted cash flow valuation in that sense, or do you sort of use a confluence of both?
Yeah, both, or a lot of things actually. The valuation process is definitely much more of an art than a science. I don't think I've valued a business. I don't think I valued two businesses the same way throughout my short investing career, just because everyone is different and the situations are different. I think in line with seeking out mispricings, like I was talking about earlier, if you can see like an egregious multiple discrepancy between something I'm looking at and where peers are trading, or where the industry is trading, if you can see a company generating an incredible amount of free cash flow, but the shares are available at cheap prices, again, for some reason that is probably fixable, that always gets my ears to perk up. If you can look at maybe past M&A transactions and determine that a typical business with very similar profiles of some of the businesses that are being acquired is trading at a severe discount, that gets me interested. So I think it's a combination of a lot of things. DCFs are important for sure, depending on the type of business. If you really want to break out the drivers of everything and really get familiar, I don't use them often. I do use them kind of at a high level and without diving into each individual business segment. I just like to kind of discount free cash flow or earnings back to see where I end up in terms of like a price I should pay today. But you have to follow that age-old adage, which is garbage in, garbage out with a discounted cash flow. You can kind of tweak the numbers to look good if you want, or to kind of make any valuation
Right.
look attractive. So you really have to be careful there. I would say that what I'm doing, I'm basically trying to underwrite 3 to 5 year doubles, which has become kind of a common phrase lately. But that basically means that you want to earn 15 to 25% over a 3 to 5 year period. And if I don't see there's a path to do that, I'm probably not interested. So in line with what I was saying before about mispricings and investing in a concentrated way, the valuation to me has to just look like ridiculous. Like, again, as I'm researching a business, I have to be like scratching my head and going, this makes absolutely no sense. It doesn't make sense from,
Right.
a DCF standpoint. It doesn't make sense from an M&A M&A comp standpoint. It doesn't make sense from, a comparable multiple standpoint. And so that kind of thing gets me interested and maybe shows that there's a severe valuation, as long as it's not, a crap business that is going through in secular decline, or in an industry in secular decline. But it's definitely, like I said, more art than science. I try to get really familiar with a business, and then I'll derive some projections based on whatever thesis I have at the time. And then I'll try to stress test the projections and sort of derive a range of values for the business. And then if I can find like a reasonable range of values for like a given set of scenarios, meaning, if things go really bad, what happens? If things kind of stay the way they are, what happens? If I'm, underestimating the potential here, what happens? And I'll try to find like a valuation range as opposed to like a specific number.
Yeah.
And if there's still a major mispricing there, even on like the bear case or the worst possible scenario, then you're probably onto something interesting. I've just never been able to, I could derive one, but I've never been able to rely on like a firm price target, because it seems to me a little bit like, people who do that, nothing against them. It just seems to be deriving some false precision. And I've never been able to hang my hat on a specific number. Like, in 2023, this business is going to be worth $16.80 a share based on, a 15 times multiple of their free cash flow. Like, I could say that stuff and I could come up with a number, but it wouldn't make me feel like I really understand what's going on. So for me, it's more of like coming up with a range of values based on different scenarios.
And one thing that I found interesting of what you said is, you said that you use a lot of scenario analysis, and the dean of valuation, Ashwath Damodaran, what he does is he sort of uses Monte Carlo simulation. So is that similar to what you do at Greystone as well? You sort of
yes. I don't typically use those per se, but I guess it's my own version of just trying to determine what the worst case scenario is and what the average scenario might be, and then what like a positive bull case scenario might be, and figuring out how likely each of those scenarios are to take place. I don't know if I formalize it that much, but it's more just kind of taking like the investment thesis and then deriving some rough estimates from that. But I read this blog post a while back by a hedge fund manager named John Hempton. He runs a firm called Bronte Capital, and I think he's I think they have mostly like a short book or something, but he's a pretty famous short seller and really smart guy. And they were just talking about how that they don't really ever have like a buy and sell price for stuff in the portfolio, because that provides a lot of false precision. And he even said that it seemed like silly and counterproductive. And I agree with that. But he went on to say that like Coca-Cola, for example, the valuation at the time it was attractive wasn't really important to the buy case, because it may have even detracted from the buy case, because you really had to get familiar with the business, and it was just very hard to get. You wouldn't buy it based on a specific price target, basically. And so he kind of went on to break down the valuation process, saying that the most important thing you need to figure out is what you need to believe in order to get your money back. And when I read that, it kind of was like life-changing to me. Like a light bulb went off in my head. It was like, well, you need to really understand the business on a deep level. You need to do the work to be able to derive like a range of values, and then you need to figure out how likely they are to come true. So anybody can put a high price target on a business, but you have to believe XYZ to be able to achieve those high price targets. And getting to that, the crux of that right there is the most important part of the valuation process. I think way too much emphasis is placed on like a specific number or a price target or something like that. Because and then on the opposite side of that, from that, he talked about averaging down, which kind of fits into what I just said, where if you have a price target of something at like $50 and you loved it at, 30, $40, you might love it more at 25. But if you're wrong about the competitive positioning or your thesis or your analysis, it's going to be a disaster when you average down, because you're almost as likely to be wrong at lower prices. And then if you liked
Yeah.
it, at $30 and it's at $12, you could equally be wrong, but you're still buying more. So basically the idea is to determine, like I said, what you need to believe in order to get your money back. But then you have to try to figure out under what circumstances might you be wrong. And if you are, how can you tell? And if you have those things covered, meaning if the possibility of losing money in the short term is, or I guess the long term, is very slim, then you're probably likely to do pretty well. And I would say that some of the investments that I made last year kind of fit that profile, just in terms of it was
Yeah.
very hard for me to determine how you would lose money given a variety of factors, but which made it attractive. But then you have this other side where as the business improves and things kind of turn around and we move past COVID, et cetera, things could look really good, assuming, people want to pay the fair price for the businesses. So so valuation is always a tough question, but probably more about deriving like a range of scenarios than like a specific number.
Absolutely. Why don't you move to some of your holdings? So I wanted to first start off with the ticker RICK, which is RCI Hospitality Holdings. So now one of the things I want to ask you is this is a nightclub company, so it's sort of one of those companies that's pretty that's affected by lockdowns. So I want to ask you, how did you build the conviction to hold and purchase more RICK during the midst of COVID-19 when there was no reopening in sight?
Yeah, that's a good question. So the answer is pretty simple. I mean, I did a tremendous amount of work just around the competitive environment and the management team and the industry itself. And basically, so to back up, the company made it through last year with at a portion of the year, at multiple times during the year, with almost their entire operating nightclub operating base closed, and they still generated positive cash flow. Q3 and Q4 were good. They grew their revenues. They started to reopen toward the end of the year, so things were looking good. But they made it through the entire year with all or a portion of their clubs closed. And what I figured out early on was that their cost structure is such that their cost structure is made up of mostly variable costs. So it made it very easy for them to scale everything back during times when they weren't making money or where people weren't allowed into the clubs. And so that basically allowed them to survive and kind of pare back everything that they were doing, during the times when they're fully opened. And so you could kind of see, in speaking with management and doing a little work throughout the industry and speaking to other operators, you could kind of see that there was a path for them to be sort of self-sustaining during the pandemic. And I guess nobody knew how long it would take. We're still going through this, obviously, but nobody knew at the time how long it would take or what it would take to kind of move through this pandemic. But I guess with everything I own, I try to be really optimistic and assume that whatever's taking place, it will pass, just like past crises and pandemics and issues in the world and global economy. So it's probably not a perfect answer, but I got confidence with their capital structure. Most of their debt, or if not all their debt, is secured by real estate, so they have the ability to roll it over or refinance it. It's not like a revolver or a term loan that may be due at a certain period of time where they might get squeezed on a lower revenue or cash flow base. And then so the management team did a tremendous job of kind of curbing their costs, which I figured out early. And then kind of in line with that, they also saw this amazing emergence of their restaurant segment, a restaurant called Bombshells, which is a sit-down sort of Twin Peaks Hooters type of restaurant, although has sort of a different bend to it. And they saw the real emergence of that segment during all of 2020, where nearly a third of the restaurants in the U.S. were shut down. And the company not only exceeded management's expectations, but everybody else's, where they went from, they have 10 restaurants open, and they went from generating, 20-30 million revenues to a run rate of 60 with like 20% operating margins. And now they're in talks to franchise the concept and to continue to grow that store base. So they're really propped up by that as well. That was a real positive coming out of last year. But yeah, I mean, I guess investing too, a lot of it is about making decisions with imperfect information. If you had kind of stepped back during the time when I made the investment in RCI and said, okay, so your big idea this year is to invest in a restaurant when nightclub and restaurant, when every single restaurant and nightclub is being closed due to the pandemic and social distancing requirements. And it would have seemed pretty silly, but there's a little bit, and I think that's actually what kind of created the opportunity and drove some people away or drove some people to sell. But there was a lot of details, a lot of really important details below the surface that opened up the opportunity to do pretty well in the name. And I think even today, full disclosure, I still own RCI Hospitality, and it's my largest position. I would actually argue that the risk reward here is more favorable today than it was back then, where there was a lot of uncertainty. So, thankfully they made it out of that period. And last year they did really well, despite having the majority of their clubs closed. So I'm expecting this year, as things ramp back up and all this pent up demand in the economy moves forward and is kind of transferred to more experienced things as opposed to, purchasing material stuff. I expect them to do really well and have a very nice year. And with the emergence of their bombshell segment that I just talked about, I think the future is very, very bright for the business. And I'm happy to be partnered with the management team, who I don't think there's a person in the country who can run this business better than Eric Langan, who's the CEO, who's been doing this for 30 years and bought his first nightclub out of college after selling his baseball card collection. And he just kind of eats, sleeps, and breathes the business. So I think the future is very bright for them, and happy to be partnered with that management team.
Got it. Yeah. One of the other theses that I found interesting, especially in your Q4 letter, was that of liberated syndication, LSYN. So could you sort of explain that thesis and what you see in that company?
Yeah. So I think liberated syndication, and full disclosure, I still own that in client accounts. That was a really interesting situation, in line with finding a mispricing and also investing in a business where there were kind of some easily solvable issues. The opportunity with them was kind of like hiding in plain sight, because I don't know how familiar you or your listeners are with the business, but Libsyn is a podcast hosting platform business, and they generate recurring revenue off of their hosting platform. And they also have a website hosting and domain name business that generates some cash as well. That's kind of less important to the thesis. But they're a podcast hosting platform, and they have more of the top 400 shows than any other podcast hosting platform in the industry. And they've done really well over the last few years, starting in 2016 as the kind of boom in podcasts has taken off, as I'm sure you know. I should ask, do you use Libsyn?
Oh, so I think the revenues are about to go down because they don't have market champions.
Yeah, well, that's all right. It's a competitive space, so there's plenty of other options. But this was a solid business that generates a lot of cash, and in my opinion, has historically reported earnings well below what I thought was like the true earning power of the business. And I came across the company, I think just by accident, by reading somebody's write-up or seeing something on Twitter. And I saw that they had cleaned up kind of much of the hair that was around the company with the involvement of an activist investor. And the shares were trading at a pretty depressed multiple of what I think the business is worth, and still are. And they happen to be at somewhat of an inflection point. And so I thought that with simple things like what the activist was addressing, like increased investor relations efforts to communicate the strength of the business, a right sizing of the cost structure, which was historically elevated because management paid themselves too much money. And if they could just continue to execute as the leading podcast hosting platform, I thought the future was pretty bright. So we were able to buy shares at a low double-digit multiple of free cash flow. And again, I think that if the business can continue to execute, we should do pretty well. But there's also the opportunity for higher revenue growth, for margin expansion, and for multiple expansion moving forward. It's possible that they'll get acquired maybe by a larger platform that's looking to kind of expand their hosting capabilities, or get a hold of some of the top shows that Libsyn hosts, maybe Spotify. But they traded at a discount to pretty much every relevant SaaS peer and recent podcast industry transactions that are taking place at what seems like an increased pace these days. And in addition to that, the difference between them and some of the transactions that have taken place is that Libsyn is profitable and they're generating a ton of cash. And so I think as long as they can continue to execute, they should do pretty well, because the fundamentals are really attractive. The space is really attractive. I think with improved communication and sort of disclosure of some of the important metrics of the business, investors could get pretty excited about this company. I don't really like, I don't usually go after like sexy stories or industries or anything like that, but podcasting is kind of one. It can be, I would say it's looked at as a little bit sexy. There's a lot of deals taking place in the space, but this is just a solid business that has been executing really well. And now that they're currently looking for a new CEO, but now that the former management team is rearview mirror, I think things could start to look really good over the next 12 to 18 months.
Right. Yeah, absolutely. So one of the other things, one of the probably the last company that I'm going to ask you about in the interest of time is you own a company called USAT, which I think is USA Technologies. So could you sort of explain the dynamics of the enterprise software industry? What allows a company to win in that industry, and how USAT, is poised to do exactly that?
Yeah, that's a good question. So I would say that of all the companies that I have written about or written up, USA Technologies, which is a vending machine management business that operates in two segments. One is a payment segment where they have hardware installed on vending machines, and they get a cut of the transaction revenue as somebody swipes their card or uses their mobile app to pay for, a bag of pretzels a bag of pretzels or a soda or something. And then the other side of the business is they have a software offering that helps vending operators run their entire business, and can be looked at sort of as like a logistics suite, where if you own multiple vending machines, you can use this software to manage your inventory, to do efficient route restocking, there's accounting software on there, to collect, to invoice, to do whatever you need to do. It's kind of a one-stop shop for vending operators. And I'd say of all the businesses that I've written up or that are in my letters, this is the one I get the most questions on. Since I put that letter out, I think I've fielded questions from like everybody. It seems like every week something comes through, which is good because I'm glad there's some interest there. But USA Technologies has skewed a little bit higher in terms of market cap than I like. It's a 600 million some market cap, and even higher enterprise value because they have a little bit of debt. But so to answer your question, basically what the opportunity that USAT has is they have an installed base of vending operator customers that have adopted their hardware technology. It's called ePort, which is one of those little tiny readers that you see on a vending machine where you can swipe your card or you can use your phone to make a purchase. And the opportunity with them is they're trying to they already started doing this, but they're trying to take their installed hardware customers and cross-sell their software logistics offering to those customers. And the thesis basically is, as they do that, not only will the revenue mix shift for the business, but the fundamentals will start to improve a lot for a variety of reasons. But as you start to sell more recurring software packages, and those are at higher gross margins and they are at lower costs, the fundamentals of the business could look a lot different a few years out if they're able to execute on that side of their business. But before we get there was just a bunch of low-hanging fruit that is being addressed and will be addressed moving forward by an activist investor that ousted the former management team. And then you have a new management team and board in place that with an incredible amount of experience running software businesses and getting companies sold, who are kind of driving this thing forward. And I'm assuming that the work I did basically tells me that the due diligence that they did before joining up with USAT was that there was an incredible opportunity to kind of grow the software side of the business. And I would say I probably am not as equipped as others to talk about the enterprise software industry in general. And USAT, I would say, probably sells more to individuals, so it might not be as applicable to them. But I would say that it just helps a tremendous amount if you have a software solution in like a niche product or service category that you can sell into, and one that's sticky, where if somebody adopts your hardware or your software service, they're very unlikely to switch to another one, especially if it's working. And the value prop here is very big because for two reasons. One, because newer machines who are fitted with newer hardware and use the software services can put higher value items in there, which leads to more revenue. But also because there are some cost savings there with having to kind of do things yourself without a software solution. So think about if you own multiple vending machines and you have to restock, you might have to buy more inventory than you need. You might have to spend more time on the road visiting those machines. You might have to do things that cost you time and money. And you said the software side of their business aims to kind of take care of that for vending operators. And so I kind of came to the conclusion based on some conversations with consultants and operators throughout the industry that the software is pretty irreplaceable for most people who say, like, I could never picture running my business without it. And the vending machine industry is made up of mostly large operators who control like over 50% of it. So once they adopt your software and roll it out to, your hardware and roll it out to all their machines and then adopt your software, it can be a very sticky and valuable thing for the business. But yeah, I would say that having them focus on their niche in terms of selling just that vending and logistics software will sort of provide a big leg up for them just because of their big installed base. It will be very hard for an incumbent to kind of come in and replace that either level of service or the value add there, or again, get somebody to switch off of their hardware software offering to join up with them. Because like I said, once you have it installed, you're very unlikely to switch to a different one. And I think that the business will look very different within a few years if they're able to execute on that software opportunity, especially because tackling the vending management industry first might lead them into different verticals and adjacencies such as laundry or gas or retail or micro markets or whatever it is. And I haven't assigned much value to that or international expansion or anything, but I think that if you have a piece of software with a very high value proposition and you're not shielded from competition, but you're kind of selling it into this niche space, and you've got customers that are willing to adopt your software solution because they're already attached to your business in some way. In USAT's case, with the hardware that they've installed on machines, it can lead to pretty powerful stuff in terms of like where you're able to grow your software revenue or how that impacts your top line overall. So I hope that answers your question, but that's kind of how I'm looking at it with USAT.
Yeah, that was a great response, actually. So in the interest of time, I've got 2 more questions left. So I wanted to start off with, how do you size positions in terms of risk management and picking how much to bet?
Yeah, so that's a good question.
You're concentrated. So I just wanted to know, how you usually probably say 10, 15% on one trade. So how do you pick how much to bet?
Yeah. It's a good question. Something I think about a lot. And I just wrote in my last letter about utilizing starter positions more, because there are businesses that I come across occasionally that I want to own and I want to do more work. And maybe I see like a near-term catalyst. So I want to maybe make sure that I have, if it's a good opportunity, I want to maybe make sure that I own some. And then as I'm doing more work, kind of tweak that ownership percentage as I go. But that's just for starter positions, which usually don't make up more than 2.5 to 3% position sizes at cost or in the beginning. But I mentioned earlier in an earlier question about kind of the two types of investments that I make: core investments and special situations. For core investments, I would say like RCI Hospitality is a good example of that. I would say portfolio weightings for those usually can be anywhere in like the 8% to 20% range. I would say a 20% position size is very rare, and it's usually made up of a rising share price and additional purchases, like averaging up, as opposed to entering into a 20% position at cost. I don't think I've ever done that. And again, in order to compound money for long periods of time, you have to survive long enough to be able to do that. And putting positions on at very huge percentages of the portfolio that, you never know what can happen. Obviously, nobody predicted COVID in March of last year. Kind of puts you at a disadvantage in terms of flexibility. And if something goes wrong, you can kind of blow yourself up a little bit. I don't use leverage or options or derivatives or anything like that. So I'm pretty plain vanilla in terms of my longs, but 20% position sizes are pretty rare. I have to see something like RCI Hospitality that I just really like. And again, where I'm just thinking to myself, the potential to lose money here in the short term is so low, but the upside is so great that it just warrants a really heavy position weighting. But most of the time, core investments, like, because they make up such a large percent of the portfolio, they're usually purchased with a very, very large margin of safety, whether that's a cheap valuation, a clean balance sheet, a discount to peers. But with those, especially with the ones that are larger position sizes, frequent reanalysis of those positions are conducted, and special attention is paid to that position size. And I just kind of, in a simple way, kind of want to keep our positions to sizes where I can sleep at night and I'm not worrying about something happening. So those really large position sizes are pretty rare, but it can happen in the right situation. And then for special situations, they're a little bit different in terms of their time frame and what they look like. I would say when I find a suitable one, I probably won't enter into. I usually enter into maybe a 5% position size with those at cost. Sometimes less than that, and that can change, as catalysts come and go, as I see, improvements or execution or something along those lines, or if it's a special situation where I don't think it will turn into a core investment, but there's a low probability of losing money and a very high upside, or at least I see like a path to, greater than 15, 25% returns in a short period. I may make it a higher position size. I did not invest in this company, but as a good example, Collectors Universe, recently, I don't know if you're familiar, they're I believe a card trading and authentication services business, was like all the rage on Twitter. Recently, the company just got purchased for, I think, $92 a share, and it was trading at $75 a share, which was
funny story actually, because I found it at I think it was $15 a share back in March, but I didn't I didn't buy it. And
oh no. Oh no. Yeah,
I found it before. I think it was Alta Fox Capital, Connor Haley. He found it as well.
Yeah, he was a huge advocate for that
Right.
company.
He was an activist, actually. Yeah.
Yeah. And so for that situation, that could be after the deal price. I think that business is like a future compounder. Unfortunately, it's being taken private, but after the first deal was announced at, I think, 72 or $75 a share, the shares obviously rose to that level. And then you had all the shareholders who were not tendering their votes to accept the deal price. And you realize that the offering group was going to have to bid a lot higher. And I foolishly sat, on my hands there, but you would have ended up, I think, earning like an additional 20, 22% if you had just kind of put the pieces together and read the offering documents. So I missed out on that one, but that's a good example of, like, I would have made that a greater than 5% position at cost, because you had a short time frame, you had a hard catalyst, you had a very low chance of losing money. And now that I'm talking about this out loud, I'm making myself depressed because I missed out on it.
I missed out on it as well, so we're on the same page here.
Yeah. But yeah, just going back to my my original point about underwriting returns, I'm trying to stick to that sort of 15 to 25% per year over 3 to 5 year period. So if I feel like that's doable, and then there's some real safety there in terms of the balance sheet or the cash flows or peer multiples, then I'll probably make it a decent sized position. But it also depends on my conviction level, which comes and goes depending on the business.
Got it. So my final question for you is, your Greystone Value structure is slightly different from, say, the average hedge fund. You guys, you run separately managed accounts, or SMAs, compared to hedge funds, and I believe that you mentioned that overall the costs and the fees are lower. So, I have to ask you, number one, is it harder to manage an SMA? So, you have different portfolios compared to, say, managing just one hedge fund portfolio. And, how do you know when the interests of your clients align with yours or not? If if the second part makes sense.
Yeah, that does make sense. That's a great question, actually. So I'll just give you the short answer for the first part of your question. I do not like separately managed accounts. I state at the beginning of my letters that I'm doing this for the time being because I don't believe I have the level of assets that would make economic sense to run a hedge fund given the costs involved. That's my aim moving forward, is that at some point I will transition my SMA structure to a fund structure and turn it into a limited partnership, which is ultimately what I want. And obviously turns that into a pooled capital vehicle where I just kind of have sort of the overall portfolio to deal with. Separately managed accounts are really tough because you can never predict the timing of incoming or outgoing capital or the amounts. So if I find a good investment situation and I have client accounts that are fully invested or have minimal cash or something along those lines, it's difficult to. I don't ever like selling anything, even unless it's to buy something even better. But I have to deal with kind of I have to deal with two things: both the inflow and outflow of capital and the
Right.
availability at the time, and also the timing of finding new ideas if I want to add them to the portfolio. And so it's kind of tough to manage at times because select clients can have different weightings of the same business, or they can have different portfolio structures at times, depending on the opportunity set or when
Right.
I've onboarded somebody. So last year was a good example of that, where I had multiple people who were papered and ready to go in March, and then the
Lapsed.
the market tanked, and we were ready to go with a fresh pile of cash and we were able to kind of bottom tick what was happening with COVID. And then, I had somebody who joined in November of last year, so a few months ago. So their portfolio looks different than the person in March because the opportunity set is different, and the risk rewards are different, and the position sizes are different. It's mostly the same for the most part, but it is difficult because you kind of have to reassess the risk reward for each new pool of capital and new account
Right. Yeah.
based on what current clients own, as opposed to just having like this pooled vehicle where you have like a cash position and then you own a bunch of other businesses at the same time, or you're just managing the portfolio. So it's not my favorite thing in the world, but the positive there is that it keeps my expenses and my costs very low. I work from home, kind of out of a spare bedroom in my house, and it's just been really helpful from that standpoint. But at some point, I will transition to a fund structure.
Right.
And then to answer your question about alignment, that's something in line with what I was saying earlier about taking a look at the investment environment and not liking what I saw. One of the biggest things was that there are studies that have been done throughout the investment industry that reveal that less than 50% of investment managers have even $1 invested in their own funds. And so I kind of took a look at that and thought to myself, that is the most asinine thing I've ever seen, because how confident can you possibly be when you're making a recommendation to somebody to invest in something, and how much conviction can you have how much conviction do you need when you're not affected by the outcome? And I just am very turned off by that behavior. And a second ago, I said that was silly behavior to me. Well, it's not silly at all, because if you run your business that way and you collect a fee of assets under management, you make money whether your investors lose money. You make money whether they make money. You probably get a bonus if they make money. But when they do poorly, you still do fine. And I just don't really agree with that much. So it's not really how I wanted to run my business, and wanted to have it be differentiated in that aspect. So I kind of took a look at that, and I do charge a management fee. It's mostly to cover like research expenses and some other things. But my performance fee, which is 20% of performance above 5%, basically makes good performance expensive and makes bad performance very cheap, which is how I feel it should be. Right. But the alignment process happens where when I am speaking with a potential client during the onboarding process, there's a couple like filters that I have in terms of their time horizon, if they understand what I'm doing and what I'm trying to accomplish, how they handle volatility, their history with other investment managers, and where else they have their money, things like that, where you can kind of get a sense of how somebody's thinking about putting money with you and what their time frame might be. I think when I transition to a fund structure, I will have some sort of lockup in place, or I will try to, because that really incentivizes kind of long-term thinking from both the GP and the LP side. But I don't have that right now, but I've convinced people to, kind of stay the course. There's just nothing really on paper. But yeah, and so I try to make sure that our views are aligned, like we're kind of on the same page in terms of how we're thinking about the opportunity set and like the next, 10, 20, 30 years, which is hard to do because, people will tell you how they feel, but that can change, when the market is doing poorly. Right. But the most important thing is that my entire net worth and my family's net worth is invested in my firm. So I eat my own cooking, as they say. And right. The popular expression is I have a lot of skin in the game, meaning I'm just as affected by good or bad outcomes as my clients are. And that will be the case for as long as I manage money, because in my opinion, there's no other way to do it. So I think the biggest thing, the thing that will drive my success or our success more than anything moving forward, is having the right clients and people who think the right way and allow you to think long term in terms of your investment decision making. Right. And so I spend a lot of time trying to find that alignment when people express interest about putting money with me, and I've turned people down who I know are not going to be a good fit. I hate to do that because, like I said, I'm trying to scale my firm as best I can, but I know that ultimately, taking on short-term assets, for whatever reason, is just going to hurt me in the long run. So, like I said, I set out to build this business for the next couple of decades, not the next few years. So, absolutely. Yeah. The alignment really comes with trying to have new clients hit those filters, but also with me, right, one of the largest investors in my firm right now.
Right. Got it. Well, thank you so much for being on the podcast, Adam. It was awesome having you. Lots of great information. I think, the listeners really enjoy it. Thank you so much.
You're very welcome. Thank you very much for the invite and for having me on. This has been really fun, and I appreciate all the questions. Right. Next time, I'll make sure that we can do this on video. And thanks again. I really appreciate it.
Thank you. And that's Adam Wilk, future Warren Buffett. Thank you.